Clearly there's plenty of gas. We expect that gas to be available fairly cheaply. In general, the U.S. was about 75 billion cubic feet a day last year. We expect that to be anywhere from 85 to 95. The Appalachians is going to be very productive. We're going to see significant production come in from Marcellus, Utica. Operators there are significant, have been very successful in reducing costs. We see break-evens of around $1.50 in some of the best areas within the Marcellus. So we expect that to bring in a lot of production. And then the next big tranche of production growth for gas is essentially going to come in from a place like Permian, where they are essentially drilling for oil, but you're getting some gas. If you look at 2017, for example, we were at about 20 billion cubic feet a day of associated gas production relative to about 75 billion in terms of total production. We expect the share of associated gas to continue to grow moderately or maybe at least stay the same as new gas production comes on stream. We see break-evens of around $1.50 in some of the best areas within the Marcellus. So we expect that to bring in a lot of production. For the next 10, 15, 20 years, we expect the price of gas essentially to be at less than $3 if you're close to some of the associated plays, or at worst less than $4 a million BTU. In terms of crude oil, we were at little less than 9.5 million barrels per day last year. We think it'll be anywhere from 10.5 to 12.5 million barrels per day by 2020. Permian is the big player here. That's where the bulk of the growth is coming from. We will see some additional growth coming in from some of the other plays. Scoop stack is people are talking about that quite extensively. We see some potential there, but there's lots of opportunity even in places like Eagle Ford, where drilling activity has fallen down much faster as a result of lower oil prices. We think there's the opportunity for more resurgence there once oil prices pick up. We're looking at the most attractive plays in the U.S. today, and break-even prices are anywhere from $25 to $35, $40. So it's very attractive break-even pricing if you're in the best place, and that's where the bulk of the production is coming from. But in general, right, onshore light tight oil, and OPEC are really the most competitively positioned on the cost curve, and we anticipate that to essentially bring in the bulk of the supply in the market. If you look at the outlook for oil pricing, we think that it's going to be in and around the 60s, mainly because the floor is set by this OPEC deal. OPEC has been incredibly disciplined. 90% of the cut has essentially been complied with. But U.S. shale is acting as some sort of a ceiling, right? Once we see oil prices rise, we're going to see more production come on stream, and that's then essentially going to put downward pressure on prices. Operators continue to push the cost curve. They're working very hard. They are getting much more organized. In terms of pricing and what impact that will have on the market, there are high expectations that onshore suppliers will be more disciplined with their capital, and therefore we would expect a sustained increase in oil prices. We are a little skeptical of that. We don't think the oil patch is very restrained when it comes to drilling when prices pick up. Right, Anadarko has announced a buyback, Pioneers has announced a buyback, and Cana is cutting down on its CapEx. But at the same time, you see larger players seeing opportunities and going after that in a pretty aggressive way, right? So, for example, ExxonMobil saying it's going to commit $50 billion over the next 5 years to primarily get more acreage in the Permian. So we are seeing those kinds of trends where, in this time, the larger majors who have essentially not bulked up on the acreage to see this as an opportunity to go and add acreage and increase their exposure to U.S. onshore. If you look at U.S. onshore production and you look at all the companies that produce light tight oil, about 70% of production is coming in from about 30 companies or so, right? Most of them are publicly listed companies. But the remaining 30% is coming in from a very fragmented base of small players, most of whom are private equity funded. And they're continuing to be very successful in raising money. Warburg Pincus, who's of course a big Permian investor, they made 2 big investments. So the world is awash in capital, and essentially that capital is trying to find a return, and a lot of that is flowing into private equity companies. So today there's $1 trillion essentially waiting to be deployed. There are bottlenecks, frac equipment, there are long lead times, proppant supply is getting limited, logistics is challenged, you can't find truckers, but all of them are reflective not necessarily of potential challenges to shale, but they're reflective of how frenetic the pace of activity is in the shale. So collectively, right, we don't see a lot of disciplined decisions or disciplined capital spending coming to the oil patch anytime soon. I think the moment prices rise, we'll see much more production come on stream, and that will have an impact. In terms of demand, clearly the emerging markets are going to be important in terms of demand growth for oil and petroleum products, but carbon limits are coming in, the vehicular fleet is adjusting and responding to those limits, and that coupled with other refining infrastructure limitations are essentially going to drive primarily refined product as well as crude oil exports from the US. Oil demand growth has been pretty robust actually in the last few years, close to 1.5 million barrels per day. And a lot of that is getting tied back and driven primarily by emerging economies. In terms of the big drivers for oil demand growth, right, if you look at the automobile fleet and you say, okay, vehicle sales and all of that stuff, we anticipate growth there. Of course, the growth is going to moderate. We expect growth to be a little slower than what it has been historically. And of course, a lot of that growth is happening in places like China and other emerging economies. A lot of chatter about battery-powered vehicles, electric vehicles, a lot of media hype around it, and the numbers look very attractive, right, when you look at it in absolute terms. But when you look at it as a percentage of fleet, it's a very small fraction. It takes a very long time. It takes 15, 20, 25 years for new automobile technologies to get to 10, 15, 20% market share. So we anticipate similar challenges for electric vehicles, right? Globally, most of the regions are adopting energy efficiency standards or fuel economy standards. Essentially, most of the OEMs are basically producing very fuel-efficient vehicles that meet a certain fuel economy that allows them to sell that vehicle in any market globally. Gasoline demand in the US over the next 15 years, we think that in a base case, we're going to see demand destruction of close to anywhere from 1.7 to maybe 2.5 million barrels per day or so. And a lot of that, right, in fact, the bulk of it is coming in from fuel efficiency standards, from fuel economy, mileage per gallon standards, than it is from electric vehicles. Where is all that gasoline going to go, right? I mean, we are not seeing any reduction in processing rates for refineries, and essentially a lot of that product is being exported. Over the last few years, we have seen dramatic growth in fuel exports, and a lot of that is essentially heading into places like Latin America. So some of them is now finding its way into Asia as well. In terms of gas demand, gas monetization options, essentially LNG is the story all the way. We'll see some opportunities, for example, in methanol. If you take US gas demand and you break it down in the 4 major components, right, residential, commercial, industrial, and power generation, and you say, what has happened in those markets over the last few years? Residential and commercial have actually declined. And if you look at industrial gas demand, we have seen a little bit of an uptick. And the other big area where we've seen dramatic increase is gas-fired power generation. Other than power, there's not really big stories to write about in terms of gas demand. And then we talked about how there's significant gas supply. So where's all that gas going to go? And essentially a lot of that is going to be exported as LNG. A lot of that is coming in from Asia and to a certain extent the Middle East, right? Demand for that LNG. These economies, they are growing, so they need more energy. But more than that, they are under severe environmental pressure, right? About 80 million tons per annum of capacity already fairly reliably projected, but we think that it could go up by another 50% to as much as 120 by 2030. So if you look at overall demand growth and you break it down in natural gas, right, essentially what we are saying is if you're at close to 75 billion cubic feet a day today and demand will be about 90 in 2020, and you break that down across the different components, exports, right, whether it's LNG or it's through pipelines to Mexico or Canada, account for the bulk of that demand growth. In general, overall, right, the US is transitioning from being a large consumer of energy to being a large consumer of energy plus being a large exporter of energy. All of this has implications, right? Because in the past, we'd worry more about oil pricing and not worry about a lot of other commodities or how they interacted with oil pricing because we were the largest consumer of oil and that's what we were worried about. But now, as an exporter, right, we have to wonder, okay, there's oil pricing. How does that tie in with supply from OPEC? How does that supply from US onshore shale? When you talk about LNG, you're exporting LNG that competes with renewables in emerging markets, that competes with other coal-fired generation, for example, which means that we have to be much more thoughtful about the big trends that will have a big impact in the market.